Welcome to this episode of Invest You. Today we're going to be going through top 5 equity investment tips for a bear market. So recently there's been a lot of volatility in the markets, and we're on the brink of entering into a bear market. But the good news is stocks are on sale. And I think a good point to bring up is one that Warren Buffett has made previously, which is be fearful when others are greedy and be greedy when others are fearful. So as we enter into these times when others are fearful, now is our time to focus in on investments and look for great deals in the market. So 5 points for investing in a bear market is we want to buy great businesses cheap. So we want to look at what the market is offering right now, and we want to focus in on good businesses that aren't really going to be impacted in the long term. I think a good example of this, if you look at Disney at the moment, it's shutting down its parks, which is really going to impact its revenue. But at the end of the day, if I bought the Disney stock, am I worried about the long-term impact for Disney? Likely not. I think they're going to weather this storm. They may have a couple of months where the revenue really takes a big hit, but at the end of the day, it's a stock that I think is going to perform well over the long term. Use a dollar cost averaging approach. Now, this is good for minimizing our volatility, which we'll get into. The third point is Dividend Aristocrat stocks help rationalize our investing fears. So as we buy stocks with dividends, when the stock price dips, especially with the Dividend Aristocrats, we're looking at that dividend yield increasing, which is exciting for our portfolio year over year, especially with investing for the long term. We want to utilize a portfolio rebalancing approach, and we do not want to invest in equities during bear markets for the short term. There's a lot of uncertainty here. Markets can dip further, they can increase. It's really hard to predict what is going to happen, and I think we've seen that over the last few weeks. So this should not be something we want to go into for a short term. So let's dive into this a little bit more. The first point is we want to buy great businesses cheap. So what's a great business? We want to look for something that has a good financial track record, so a great cash flow, excellent margin of safety, so good price to book, ability to cover its short-term debt obligations, especially in trying financial times, so that would be the current ratio we look at, a low PE ratio, little or no debt. We want large cap stocks, so something greater than $500 million from a market cap perspective. Good intrinsic value utilizing the discounted cash flow approach. And I'll put some links below for where you can get a intrinsic value calculator. And companies that have a great moat or a competitive advantage. So for this approach, we really have to dig into the annual reports to see how they have a competitive advantage relative to other players in the marketplace. So let's dive into an example. So we have John's Toilet Paper Distribution Incorporated, and we know that this product is flying off the shelf recently. So the revenue in the last month has quadrupled, and this is projected to be the best quarter in the company's history. We have a low price to book, lots of long-term debt, and a low current ratio. The PE ratio has increased from 12 to 147, and because the stock is flying off the shelf, we're wondering, really, should I buy this stock? So at the end of the day, we really need to look at this from a long-term perspective. We need to dig into the financial history for this company, perform some analysis to look at its viability for the future, and not be influenced by short-term market conditions. So yes, toilet paper is flying off the shelf these days. It's really hard to get your hands on a roll. But at the end of the day, the market will be saturated pretty soon. It's not like we're going to be utilizing toilet paper at different rates than we were previously. So at the end of the day, I don't see this being something that is going to impact a company like John's Toilet Paper Distribution Incorporated over the long term. So one thing to keep in mind is when investing in stocks is you're buying the business at the end of the day, and you're being an owner of this business. And one way I would like to look at things when I'm purchasing a business is, if I was personally a publicly traded company, how would the stock market react to me as a result of the bear market? So when we look at our own personal situation, how do I make money through these trying times? So what is my revenue? Do I have any potential issues with making money as a result of potentially having to work from home? Do I work in an industry that's going to be impacted from a long-term perspective for sales? Is this a positive thing or is this a negative thing with the market I'm in? So think of how your income has changed as a result of this situation, and what is the likelihood that I can weather this storm. So, maybe I'm a company like Disney where I have to close down my parks, but at the end of the day, I'm a business that has a lot of cash, so I'm not worried about my short-term debt obligations. Another thing to think of personally is, have my expenses increased or decreased as a result of this situation? So what is my cost of revenue? Can I scale back on my expenses in difficult times? So perhaps I'm going out to eat less, I'm driving less, my kids aren't in daycare, so I'm saving on those costs. So my expenses have decreased slightly, but if my revenue has decreased as well, then maybe I'm getting into a situation where I'm concerned. Next point is, am I likely to come out on top, or am I going to need help through these trying times? What does my cash flow situation look like? Do I have money in the bank to cover off these trying times, or do I need some help here? Do I have enough money in the bank to cover some of my short-term debt obligations, like my bill payments, my mortgage, paying for my kids' activities when they get back to it? All of these things need to be factored in. And an example of that could be the current ratio when you're looking at companies. So what is my overall net worth? Do I have more assets than liabilities? My book value or price to book would be something that I would look at to assess companies. And really what we're looking at here is, what is the health of my financial situation? Could I liquidate some of my assets to cover off some of my liabilities in trying times? And ultimately, what is my financial health? So when I look at this from a personal perspective, I really want to take this into a business perspective. So I would not lend money to a friend that I know is not good to pay it back. And at the same time, I would not invest in a business that I know is not going to keep my investment. So it's important to look for investments that have a really good upside, but have a limited downside. And a good quote by Manesh Pabrai is, "Heads I win, tails I don't lose much." And that's really the approach we want to take here when we're investing in a bear market. So let's go through some investment rules. So I want to invest in stocks with a PE ratio of less than 25. And ultimately, this is looking at the earnings relative to the price. So for a PE ratio of 25, if I divide 1 over 25, I get a 4% return. So I want to look for something that has closer to a 10% return year over year, which would match the market conditions in the long term. So I really want to find a PE ratio closer to 10. But at the end of the day, the PE ratio to me looks at the multiplier I'm paying on this investment. So something with a very high PE ratio really sets off some alarm bells for me that the stock is overpriced. I want to look for large companies, so a market cap greater than $500 million. A current ratio greater than 1.5, so a company from a short-term perspective can cover off its debt obligations. A return on equity of greater than 5%, and this will show that as it borrows money to invest for the company for the future, it is able to cover off the cost of borrowing money by a factor of 2. So low debt at the moment is key, so I'm looking for a debt to equity of less than 50%. Consistent earnings per share growth. I like to look for stocks with dividends greater than 2% and a 10-year history of consistent dividend payments. I want stock with a good value, so the intrinsic value is going to be larger than its stock price. And I'm not investing in these stocks for the short term. And I think this is especially important in a bear market. There's a lot of volatility. I'm not sure where the highs and lows are going to be. So I'm going to want to consistently invest and hold on to this for the long term. So the second point in a bear market is to utilize a dollar cost averaging approach. So what this means is purchasing equities or stocks at regular intervals. This is important because I really don't know where the bottom of the bear market is going to be. And with every bear market follows a bull market. So I want to purchase along the way and get good deals on these stocks. So consistent, regular purchases help reduce this volatility. The one downside with this approach, though, is the higher cost cost of equity purchases. So, maybe I'm purchasing stocks on a monthly basis as I contribute to my 401k, or my RRSPs, or my regular accounts. And I'm going to see fees, $5-ish per purchase. So my cost is going to go up with this approach. But at the end of the day, I reduce my volatility with making a big lump sum purchase as I go through the bear market. So to illustrate this point, I've pulled up the chart for MasterCard over the last bear market when we had our stock market crash in 2008, 2009. And really, this whole bear market took, the better part of 2 years to recover. So for the current situation, we're really not sure how long it's going to take to recover for this, where the bottom is going to be. But if I utilize a dollar cost averaging approach, I could buy this equity consistently over time. As we get towards the bottom, I buy at the bottom and I buy on the way back up. And really what I'm looking at is the deals that are available in the market at that point, whether it's attractive to me, and if it's attractive, then I'm going to buy that stock. So the third point in investing in bear markets is dividend stocks rationalize fears. So I'm looking for equities that have high dividend payouts, consistent dividend payouts, and that's important because as we get through trying financial times, dividend stocks with consistent payouts, the chances that they are going to continue to pay this out go up if they have a good history. So typically with stocks, companies do not want to decrease their dividend payments or not pay out their dividends because they're going to see a substantial share price reduction if they go through that, especially with companies that are focused on payouts on a consistent basis. So I'm going to look at the Dividend Aristocrats in the S&P 500. So the definition here is companies that have continuously increased their dividends for 25 years and they have a history of a 25-year payout. So a couple examples of this would be Johnson & Johnson, Coca-Cola, and Walmart. So we'll go through an approach here to illustrate what I mean for rationalizing the fears with having a stock with a strong dividend payout. So let's take AT&T for example. So presently it pays a dividend of $2.08 per year per share. So looking back at the 5-year history for AT&T, it had a 5-year high of 43.21. So if I have a dividend payout of $2.08, that yields 4.8%. It has a 5-year low, however, of $28.54. So if I buy the stock at $28.54, the money that I put in would get a yield of 7.3% on an annual basis, and that would likely increase as the dividend payout increases. So as that stock dips, as we enter a bear market, I'm actually looking to buy more of this stock because I look at that yield and I think, okay, my investment is going to go up over time, and if I can lock in a 7.3% return on my investment, I'm pretty excited about that. So point number 4 is rebalance your portfolio. Investors should set rules for the amount of money that's in safe and riskier investments. So an example of this, if I was totally risk averse, I would have 100% of my money in U.S. Treasury bills, which really wouldn't make me a lot of money on my portfolio. Right now, we have a 10-year return of 0.983% per year, which is really, really low. So that's not something that would really make us money and be able to cover off inflation year over year. Now, if I was totally into risk, I would have 100% of my money in equities, which also would not be a great approach, especially as we take big hits in the market. So what we want to do is come up with some rules for our portfolio. So a higher risk approach that might be something that's utilized for younger investors that are in the market for long term would be to have 25% of your money in safe investments and 75% of your money in equities or stocks. A balanced risk approach would be to have half your money in safe investments and half your money in equities. So I would say this would be for investors that really don't need access to this capital for the medium term. So for this, maybe you're 50 years old, you're not going to retire for another 15 years, and this is the medium risk balance that you're looking at. So low risk would be 75% in safe investments and 25% in equities. So I would recommend this approach for investors that may need access to this capital in the short term. So I don't want to have a large portion of my funds in equities, especially if I need to utilize them for my retirement years. So let's go through an example of rebalancing our portfolio. So I'm going to go through a balanced approach where I have 50% of my investments in safe investments, like for example, U.S. Treasury bills, and 50% of my investments in equities or stocks. So let's assume I have $100,000 invested in total, so $50K in a safe investment, $50K in stocks, and I go through an event where stocks dip by 20%. So when I go through my rebalancing efforts, say on a semi-annual or annual basis, I would sell off $5K of my safe investments and invest this into the stock side of things. Or if I'm investing on a regular basis, I would make the investments into stocks rather than into safe investments and try to rebalance my portfolio. So in this case, I would have, in rebalancing, I would have $45K in safe investments and $45K in stocks or equities. Let's go through an event where stocks increase by 20%. So I'd have $50K in my safe investments and $60K in stocks or equities. So I'd rebalance my portfolio and I'd sell off $5K of my stocks to apply this to less riskier investments. So balancing it would be $55K in safe or $55K in stocks. Or if I was investing on a regular basis, I would try to match that $60K that's in stocks now and focus my investing in safe investments to try to make it a $60K split. So as we enter a bear market, generally we're going to see the stocks dip. So we're going to be focusing our investments into stocks or equities right now and less in the safe area when we do our rebalancing. So really what it gets us to do is to buy stocks when they're cheap and sell stocks when they're high. So the last point for investing in a bear market is we do not invest in stocks for the short term. If I was to invest in the short term, I would be focused on stocks that are making money throughout this bear market. And maybe these companies really don't have the best financial history. So I would be kind of concerned about investing and trying to turn around a profit in the short term, especially with the volatility in the market. A couple of quotes here. So stocks in the short term are a voting machine. In the long term, they are a weighing machine. So again, we don't want to buy into the hype of any of these stocks at this point in time. I want to find good, healthy companies for a good price and continue to invest in them. Value investors are likely aware of the concept of Mr. Market, the manic individual who's offering you deals constantly. So be cognizant of the deals that Mr. Market is offering you at the present basis. Chances are in the bear market, as we dive into some of the value investing concepts, Mr. Market is offering us some pretty good deals. So let's think about buying some of them, but again, holding them for the long term. It's probably not something I'm going to get a really good return on over the next quarter or so. And at the end of the day, we are owning these businesses, and I can't stress this enough. If I wanted to invest in businesses and I went into a small town and walked down Main Street, I wouldn't just throw money at any business that I saw. I'd want to look into their books. I'd want to look at how much money they're making. I would really do my due diligence before I invest my money into these companies. The same thing is true for stocks or equities. We want to understand, how do they make money? Do they have good financials? And do they have a competitive advantage in their marketplace? So thanks for tuning into this episode of Invest You. We hope you click subscribe below and check out our future videos on stocks and analysis.